right, so now we're going to take a look at Appendix A, which is using the predetermined overhead rate in order to and the overhead analysis in a standard costing system. So we're going to take a look at that. And the first thing that we're going to do is to compute and interpret the fixed overhead budget and the volume variances. And so for a fixed manufacturing overhead variance, first thing we're going to look at is a budget variance. And so the equation for computing the budget variance is shown on this slide. It is simply the difference between the actual fixed manufacturing overhead and the budgeted fixed manufacturing overhead for the period. And then a volume variance. The equation for computing a volume variance is shown here. It is different. It is the difference between the budgeted fixed overhead and the fixed overhead applied to work in progress. The volume variance can also be computed as shown on this slide. The equation on the prior slide and this equation result in identical answers. Both variance computations will be demonstrated in the forthcoming example. So we'll look at an example. So this is Coca-Cola computing fixed overhead variance. And so we see the background information here. So they had budgeted positions, production of 30,000 units, 3 hours per unit, so 90,000 machine hours. They had actual production of 28,000 units. They had standard machine hours allowed for the actual production of 84,000, and they actually used 88,000 hours. And then we see here the budgeted variable manufacturing overhead and the budget fixed overhead would come out total budgeted manufacturing overhead of 360,000, and then we see the actual variable and the actual fixed, and the actual manufacturing overhead came out to 380,000. Now, predetermined overhead rate. So the predetermined overhead rate is going to be $4 per machine hour. And it is computed as we see here. So it's going to take the amount of the total estimated total manufacturing overhead cost divided by the allocation base, in this case, the number of machine hours. And we can come out then with how much it is per machine hour. The estimated total amount of the allocation base is called the denominator hours. This rate can be broken down into the variable component, which is $1 per machine hour, and a fixed component, which is $3 per machine hour. The fixed component of the predetermined overhead rate will be used to compute the volume variance. So again, taking the variable component divided by the base, that'll give you the amount. Now, the total overhead applied to work in progress, 336,000, is computed as we see here on this slide. Notice that the standard hours allowed for the actual level of output is used to apply overhead to work in progress. In the job order costing chapter, we used the actual level of activity to apply overhead costs to work in progress. The different approaches arise because we're using a standard cost system in this chapter, and with the job order costing chapter that we looked at, we were using the normal costing system. So we see that. So we can figure out the amount of overhead applied by taking the predetermined overhead rate, which we calculated previous, and then multiplying that by the standard hours that were allowed for the actual output. And then that comes out with that. Now computing a budget variance. So the budget variance is 10,000, which is unfavorable, is computed as we see here. It is simply the difference between the actual fixed overhead, which is 280,000, and we can subtract from that the budgeted fixed overhead, which is 270,000. So you have the actual fixed overhead minus what was budgeted. And we come out with that it was 10,000 more than what it was supposed to. So it's unfavorable. Computing the volume variance. The volume variance of 18,000 unfavorable is computed as shown. The fixed overhead applied to work in progress, which is 252,000, is computed by multiplying the fixed component of the predetermined overhead rate, or $3, by the standard machine hours allowed for the actual output, which is 84,000. We take that comes out to this 252,000, what's in parentheses there. And so with that, then the volume variance of 18,000 unfavorable can also be computed using the equation that we see here. So it could be $3 per machine hour times, and then 90,000 machine hours subtracted from the 84,000 machine hours from that. That's going to give you 18,000 unfavorable, because the denominator hours, 90,000 machine hours, exceeds the standard hours allowed for the actual output, which is 84,000. It assumes it presumably signals inefficient usage of facilities, and so therefore it would be labeled as unfavorable. So we have a pictorial view of the variances. This slide offers a pictorial view of the computation of the fixed overhead volume and budget variances. And so we see how that works out, and then we come out with the total amount. And then we'll look at a graphic analysis of this. So we'll look at a graph that shows the fixed overhead variances. We will use Colaco's numbers that we got from the previous example. And so the vertical axis is used to graph fixed overhead cost. The first cost that Coca-Cola would plot on this axis is 270,000 of budgeted fixed overhead. The horizontal axis is used to graph the volume of activity. The first activity level that Colaco would plot is its denominator activity level of 90,000 machine hours. The linear manner in which fixed overhead is applied to products is depicted by drawing a straight line from the origin to the intersection of the fixed overhead, which is budgeted fixed overhead, which is 270,000, and a denominator activity, which is 90,000 machine hours. The slope on this line indicates that fixed overhead is applied at a rate of $3 per machine hour. Next, plot the actual amount of fixed overhead costs on the vertical axis, which is 280,000. We see that's shown there with the green arrow, and then we see that. The difference between the budgeted amount and the fixed overhead and the actual amount, which is $10,000, that is the budget variance. Finally, identify the standard hours allowed for the actual level of output, which is 84,000. Draw a vertical line from this activity level until it intersects the slope line that depicts the fixed overhead applied to products. From this point, draw a vertical line that intersects the vertical axis. This dollar amount, 252,000, represents the fixed overhead applied. The difference between the budgeted fixed overhead and the fixed overhead applied, 18,000, is the volume variance. And then Coca-Cola reconciling overhead variances and underapplied or overapplied overhead. In a standard cost system, the sum of the overhead variances equal the underapplied or overapplied overhead costs for the period. This slide shows Coca-Cola's underapplied or overapplied computed. The manufacturing overhead is 44,000 underapplied. And then computing the variable overhead variance. So Coca-Cola's Colaco variable overhead rate variance, which is 12,000 unfavorable, is computed as shown here. So we have the 100,000 minus the 88,000 hours at times $1 an hour, and then that'll work that out, and that'll come out with that. And then Colaco's variable overhead efficiency variance, which is 4,000 unfavorable, we see by taking 88,000 minus 84,000 hours times $1 an hour. And then computing the sum of the variances. The sum of the variable and fixed overhead variances, 44,000, which is unfavorable, is shown on this slide. Notice that the sum of the variance equals the amount of underapplied overhead. So now we're going to take a look at the standard cost systems of financial reporting perspective that will utilize Microsoft Excel. Preparing an income statement and a balance sheet in order to be able to using the standard cost information. So remember, going back, looking at a balance sheet, remember that a balance sheet is based upon our accounting equation, which is assets equal liabilities plus stockholders' equity. Or another way that you can remember this is with the acronym ALE. And I don't know if, because I know none of you, I don't believe, had me before for accounting 4A. But a joke that I like to tell students is, what is an accountant's favorite drink? Ale, right? So assets equal liabilities and stockholders' equity. So that's the accounting equation. And that's important when we start working on the rest of this. And so our retained earnings, then, we can get that by calculating the ending balance of retained earnings by taking our beginning balance that we had in retained earnings, adding to it our net operating income for the period, and then subtracting out our dividends. And so we will make four key assumptions. Is that work in progress and finished goods inventory, those are carried at standard cost. That clearing accounts begin and end with zero balances. So there are certain accounts, if we remember from financial accounting, that get closed out at the end of the period. So they begin the period with a zero, they will end the period with the zero. And then only cash, raw materials, work in progress, finished goods, and plant, property, and equipment, net, accumulated depreciation, and retained earnings. Those are the only accounts that we're going to use here. And that positive numbers increase accounts, and negative numbers decrease accounts. So we'll take a look at an example, Dillon Company. The company uses a plant-wide predetermined overhead rate that relies on direct labor hours as their allocation base. All of the company's manufacturing overhead costs are fixed. It does not incur any variable manufacturing overhead costs. The predetermined overhead rate is $25 per direct labor hour, is based on the cost formula that estimates 1,870,000 of fixed manufacturing overhead for an estimated allocation base of 75,000 hours. And so we see here the beginning balance sheet is shown, and we can look at that and we can see that they had retained earnings of 7,414, and that is shown under the liabilities and equity section. They don't have any other liabilities, so that's the only item that's listed there. They have no liabilities, so that's the only item that's listed there. If we look at our standard cost card, we see that the total cost per unit is $51 because we have our direct materials, our direct labor, and then we said that everything in regard to manufacturing overhead was fixed. And then they completed some various transactions during the year. They purchased materials, they added materials to the work in progress, and they paid expenses and so on and so forth. And we see the transaction template that we can use to record a transactions is shown as a spreadsheet. It reflects the beginning balance sheet account balances. So we just take our account balances and we input them. So now we can calculate our variances. So the material price variance is computed as $95,000, and that's favorable. And the materials price variance would be labeled favorable because the actual price, $4.75 per pound, was less than what the standard price was of $5 a pound. So that's good. They paid less than what they figured and what they had budgeted for. And then the material quantity variance is also computed as $23,000, and that also is favorable. And it is labeled, and that is labeled favorable because the pounds used in production, which is 365,000 pounds, was less than the pounds that the standard allows for the actual level of output, which is 369,600 pounds. So they actually ended up being able to use less material than what they had budgeted for. So that would have been favorable. And then in terms of direct labor variance, is computed as 36,000, which is favorable. And again, the labor rate variance is labeled favorable because the actual labor rate of $14.50 is less than the standard labor rate, which is 15. And then the direct labor efficiency variance is computed as 90,000, and that is unfavorable. And the reason for that is because the hours actually worked, which is 72,000 direct labor hours, was greater than the hours that the standard allowed for the actual level of output, which is 66,000 direct labor hours. The fixed overhead budget variance is computed as 125,000 favorable. And again, the fixed overhead budget variance is labeled favorable because the actual amount of fixed overhead, which is 1,750,000, is less than the budgeted amount of fixed overhead, which was 1,875,000. And the fixed overhead volume variance is computed as 225,000 unfavorable, and the fixed overhead volume variance is labeled unfavorable because the budgeted fixed overhead, which is 1,870,000, is greater than the fixed overhead applied to work in progress, which is 1,650,000. And in a completed transaction template is shown as a spreadsheet. It reflects the ending balance sheet balances. So that would be what the ending balance sheet balances would have been. Now remember that the cost of goods sold, selling and administrative expenses, and variable adjustments are shown as negative numbers in a transaction template in order to recognize that they reduced retained earnings. These numbers will be shown as positive numbers on the income statement. And then preparing our income statement. And we see a picture of what the income statement would be. The cost of goods sold is reported at standard, which is $4,335,000. The total variance adjustment of $36,000 is added to this amount, since they are favorable in total, to arrive at the adjusted cost of goods sold, which would be $4,371,000.